Now, to kick off 2016, I'm delighted to be joined on tonight's show by some of Australia's most respected fund managers and advisors. David Buckland, Chief Executive Officer and Portfolio Manager at Montgomery Investment Management, is along with us this evening, as is Liam Short, Financial Planner and SMSF Specialist at Verante Financial Planning. And joining definitely, David, I think Montgomery Investment Management, you've done very well in terms of performance. We were just sort of talking through the figures a little while ago, but self-managed super funds and self-funded retirees are obviously going to be a fairly important proportion of your client base as a firm, aren't they?
The majority, yeah.
And so with your sort of work that you do with those funds and those investors, you know, do the contribution limits pose any difficulty for you? Do you think it's something that they need to be concentrating on now before the legislation changes?
I think it's definitely advisable. I mean, I think the government are a little bit insane because they're going to end up with a sort of open-ended unfunded liability. And my view is that they should actually be pushing the superannuation guarantee levy up towards 18 or 20%, not 12%, and then they take off their own books that potential open-ended liability.
Yeah, definitely. So when we look at your client base at the moment, obviously it's been a pretty volatile couple of weeks for equities, and I want to talk about this a little bit more after our break and shortly, but just in terms of the current volatility, in simple terms for investors out there, what should they make of it? You know, what's caused it?
So what's essentially caused it is China, and in the latter half of 2015, China declined, as measured by the by the Shanghai Composite Index. It declined by about 17.5 percentage points. And what's actually happened is data has come out recently that indicates that the manufacturing sector in China is actually contracting faster over recent months. So in December, it had contracted faster than it actually had in November, for example. At the same time, the Chinese came up with a surprise devaluation of their currency back in August, and they did another one today. So the Chinese market, already in the first 4 days of this financial, or this calendar year, I should say, is down 12 percentage points. And most other Western world markets are down roughly about 5 percentage points. Certainly, as we've gone on air, Europe looks like across the board it'll be down about 5 percentage points for the first 4 days as well. So it's really been China-based, but the essence of it all is rising US dollar, the tightening by Janet Yellen back in mid-December, and the Bank of International Settlement believes that there's about $10 trillion US dollars of loans outstanding outside the US to non-banking organisations. And as those people who have borrowed those US dollars end up having to pay back more in US dollars as their currency depreciates, that's causing a lot of angst amongst those emerging market economies. And many of those emerging market economies are getting hit three ways. The first way is higher US indebtedness. The second way is their exports of their commodities, be it iron or oil, coal, is crashing. And the third thing is their own economies have the highest level of private sector debt to GDP on record. So they're in a bit of a very tight spot. And I think what's happened is the China thing has brought this to a head over recent days.
Yeah, respect to China. What should investors be doing at the moment? Should they be liquidating positions and getting more cautious, or should they be treating this as an opportunity actually to buy more assets?
I think they should be conservative, Tony. And let me just explain. So, for example, over 2015, the Australian market, including dividends, put on about 3.8%. They've given all that away in the last 4 days. The market, excluding dividends, is back to where it was in July 2013. So we're talking 2.5 years ago. So you've got to be conservative. That's very, very important. You've got to conserve your capital. Now, what we try and do is we try and buy capital-light businesses with good growth prospects, and that served us well. So, for example, last calendar year, we delivered our investors not a million miles away from 20 percentage points after expenses when the market did next to nothing. The problem we've got is the market has come back from 6,000 points approximately 10 months ago to around 5,000 points, and we're having trouble finding opportunities.
Yeah, amazing, right.
Now, the reason is simple, is that the rubbish has fallen dramatically and deserves to, and the high-quality stuff looks quite expensive. There's always 2 or 3 high-quality businesses with good prospects that are probably good buying, but the problem is it's not broad-based. It's very, very, very thin. So despite the fact the market's down from roughly 6,000 to roughly 5,000 points in 10 months, we're having trouble, and so our cash weightings are typically somewhere between 20 and 25% at present, despite this decline.
Wow, that's actually significant for a fund manager, isn't it? I mean, that's unusually high, isn't it, in terms of levels?
I think it's conservative. But I think that the situation is that there will be, in the next year or two, some quite good stocks just thrown out with the bathwater, and we want to have plenty of cash for those opportunities.
Okay. So in terms of where an investor's positioned at the moment, is there an opportunity there to pick up large cap blue chips at the moment, some of the beaten up banks and so forth, or are these sort of absolute avoids given what's going on at the moment?
I think it's impossible to know, because I think it depends how this regulatory horizon plays out. But it'd be fair to say Montgomery is massively underweight the banks and remains so. I think what's happened is that we've just dipped our toe in the water on occasions on very, very bad days, but I can see us remaining very, very largely underweight the banks for the medium term.
Okay, so banks are out of the question just for the medium term, but let's just come back to it. So you've managed to get near on 20% performance over 12 months. The market or the index got 3%. What are you doing differently, and how do investors assess the same sorts of opportunities themselves? Obviously, you know, they should go into the fund, but if they're trying, what sort of framework do you use?
So let's go through it. 1/6 of the market is resources. Resources is in a massive bear market that isn't going away anytime soon. Just to give you an example, iron ore, I think volume of iron ore supply will probably grow by 5 to 6% this calendar year. So I don't know how you can suddenly become positive about the iron ore complex in the foreseeable future. I can't see how you can be positive on the coal complex. I mean, oil has hit an $11 low today at $33 a barrel.
Yeah.
So, you know, there's a lot of companies out there in Australia, such as BHP, Rio, Fortescue, Santos, Origin Energy, Woodside Petroleum. We just don't need to own them. So that's point one. Now, a lot of people will say, oh, look, they'll mean revert, I'll buy them, I'll punt them, etc., etc., etc. But they could have said that 6 months ago or 12 months ago and dusted a lot of money. So I think avoiding losses is absolutely crucial. And then you go to financials and you say to yourself, is it the banks who are now under regulatory pressure, or can I go into, say, something like Henderson, the fund manager, which was demerged from AMP and has a very, very nice tailwind in the United Kingdom and Europe, or BT, which has very, very good offshore earnings. This is the BT Fund Management Group. Platinum, which I think now is probably the expensive side of the spectrum, but it's obviously had a wonderful 12 months as its funds have grown towards $40 billion to $40 billion. So you can pick the eyes out of things. Another example would be a Challenger that's done quite nicely in recent several months. Other high-quality businesses have been International Patent Holdings, has gone from $2.20 towards $9. Isenti has gone from $2 to approximately $4. Obviously, people have talked about Blackmores and Bellamy's and things like that. So you've really got to pick the eyes out of high-quality businesses with good prospects and buy them well. And if you can't do that, keep your money in the bank for the rainy day. And I think the rainy day looks like it's just starting to come.
Just starting to come, or have we got, you know, are we early stages in terms of this sell-off at the moment, or?
It's absolutely impossible to know, because it so much relates around the China situation and the emerging market situation. Now, I could quite easily see a scenario where half a dozen emerging markets, such as Turkey, Russia, Mexico, South Africa, default. They don't pay their money back. Okay. Now, I don't know how the world will react to that, but I can see that happening in the foreseeable future. Now, is that 6 months, 12 months, 24 months? I don't know, but I can see it happening.
Yeah, amazing moment. David, just while we're pulling that up, here it is. We currently hold BHP, Rio, Fortescue in our self-managed super fund and looking to get out of at least one of them, but I'm unsure which to trade. It will be a loss on all of them. So what would be your advice? We're looking to get into something like CSL eventually. David, what's your view on this?
Look, this is difficult, because these stocks have been beaten up so badly, you know. Fortescue from $7 to $1.70, BHP have halved, Rio have halved, etc., etc. So, it's take your pick, which is the worst.
Yep.
It's impossible to know. Except I will say one thing is, Fortescue has an indebtedness level that does worry a lot of commentators, but they're doing everything in their power to bring their cost of production down aggressively, and they're doing a very good job. The question I have is, to do that, are they mining their high quality reserve at present?
Yep.
Meaning that they've got a vast lower quality reserve available down the track.
Yep.
And if iron ore stays, maybe in the low 30s rather than the low 40s, then that they could, there could be sort of severe problems. Now, BHP and Rio do not have those sort of balance sheet constraints, but they'll all rise and fall together to some degree. They're all highly operationally leveraged. The problem is Fortescue is also highly financially leveraged as well.
Definitely. Well, a good answer for you there, Wendy, and I hope that helps. David, thank you so much for joining us. We have to take a break now, but folks, that's David Buckland, the CEO and Portfolio Manager at Montgomery Investment Management.